So Grammarly, couple of important things. One, Grammarly is the AI-assisted grammar checker. You're a big fan of it here at Launch. We all have a license to it. And we had the CEO, Shashir, on the show because it merged with Coda, which we use to build the Twist 500 database. An interesting matchup. We were curious about why they were coming together, what they were going to build. But today we're talking about something a little bit different. General Catalyst was the investor behind both companies, which we thought was probably why they came together because, one of their major shareholders liked the deal. Now, it turns out GC has a thing called the Customer Value Fund, which pulls from its major funds. But what it does is provides capital to its portfolio companies without taking an equity stake. In return, they get, quote, a capped return linked to revenue generated from the capital. So essentially, this is like revenue-based financing, which we've heard about ad nauseum 5 years ago, but they're going to put $1 billion into Grammarly under this rubric, which is a huge amount of money. And the idea here, as far as I can tell, is the go-to-market motion for Grammarly works. You can put money in, you get more money back. They want to do product work with their money, with the Coda a deal to build this AI future writing platform thing. So they're going to use General Catalyst money to keep growing at the same time. Win-win, Jason, or risky? I'm curious what your experience in the industry tells you about this deal.
Yeah. So number one, these two products are two of my favorite products in business. Like I legitimately pay and use both of these products daily. Mm-hmm. So shout out to the teams at both of them. And I think they probably came together because, as you said, they were both portfolio companies of GCs. And so SaaS is a difficult business. And maybe they thought, hey, we could put these two companies together and have a stronger company. This will help increase the value of the company that GC has already invested in. So if they have some LPs who want to get a return on capital, you get the double benefit. You're loaning them money instead of having them take the money from a bank. So it's all in the family. And then you increase your equity stake without adding more shares to the company and selling shares to other investors. So GC, if they own 20%, let's say they own 25% of these two companies, they don't want another person to come in and own another 25% and dilute them down to 20 by issuing new shares. Keep the same number of shares in the company. You give them this revolving credit line, I guess. And who knows the terms of how you can tap it? It might be up to $1 billion. There's a term called covenants. And the covenants are things you have to, live up to. So in a venture loan, you have to keep a certain amount of revenue, a certain debt to revenue ratio, et cetera. In this case, I wouldn't be surprised if they said, hey, you can pull down 10 million, but then you have to show the results of it. And you have to keep your customer acquisition costs here. So it's a big number. Yeah, I think it could work. Now, you checked with them. Do they have 700 million in revenue for Grammarly?
Yeah, so they announced this number. They said we have, I think, annualized revenue of more than 700 million, and they're profitable. So I reached out and I'm like, month times 12, ARR, quarter times 4, and profitable is, and I say this with nothing but love to startups, a flexible metric at times. So I wanted to kind of dig in, and they were like, we had nothing to add past our blog post. So I'll interpret this for everybody.
But you did check the facts. Yeah.
Yeah. Well, I mean, we had the facts. We just wanted to go one layer below, but they're being tied to the chest with it. So my thought of this is simple. 700 million in revenue, no matter if it's ARR, quarter times 12, 4, whatever, is incredibly impressive. This is an at-scale business. It's IPO ready. Profitable, I don't care if it's on a cash basis, a GAAP basis, an adjusted EBITDA basis, whatever. It means that the company is healthy.